Absolutely, and thank you for your comments. I mean, I think when I hear them, I think the intention is to provide maybe clarity not only to staff but to the committee and to others who are interested in the way that we make decisions and come to priorities as well, a clearer framework for where we should be focusing most of our time and maybe where there are interests for us to spend time, but where it doesn't fulfill what I think we are charged to do, which is to be fiduciaries of the system, whilst being cognizant of the changing world around us and the economic, the environmental and the social impacts that creates, both for communities, environment and on our portfolio. So I would say that the goal behind this is to provide the clarity, recognizing that in the past this has obviously been worked through, perhaps without the guide rails that we need to have good discussions where they need to be had. And I think clarifying as well the roles of, as you said, staff and the investment committee, and being clear about where we can play a real role. I think what I heard you say, Controller, as well, very clearly, is it's very hard to come up with one line which says this is what's material. But I think, again, if I call on what Chris often says, is, there is a lot of investment that is art. And in terms of us hopefully having the ability to apply some of that art in also our understanding of materiality, that should be part of our job as good sort of investment team members, to understand what materiality means for us across our sectors, across our asset classes, and across the managers that we work with. And so having that discretion and having that ability to define that without sort of saying, boiling it down to a numeric number for each, that would be too simplistic. This is part of the art of understanding where we need to be good investors. And so I guess my two responses to you are, one, I would hope that this could address your questions and address your concerns. And that's maybe what we can, if you would be willing to support as going away and clarifying. And then the second would be that there is more work to be done here on communicating this, not only in this room and to other people, but to our broader stakeholders and members, because I think it'll help maybe give them guidance that maybe we can't respond to every issue that everybody cares about. It's not because we don't care, but it's because it's not the right form, or it's not the right place, or we don't have that right influence to create the change that people are hoping for in the broader world.
Scott wanted to add something.
I'm sorry, I didn't want to jump in. I wanted you to finish. I just wanted to highlight one thing that Betty had mentioned, which I think is important that we understand, and that she gave the example of the private prisons and the quality of the work of staff, which I was very proud of as well. And in any of these cases, you can expect staff to fully engage and to produce very thorough analysis and reports. And so that doesn't change. And I think, just to bolster what Kirsty was saying, she's, I think, done a wonderful job of taking the policy that we have and just trying to provide some clarity, and clarity in two forms, hopefully defining materiality and then defining roles a bit better. But in all the cases, you can expect staff to fully engage in the company's analysis. So I just wanted to highlight that for you, Betty.
And may I just take the response to your second question, which I think was like, how are we considering, and there was news from the Norwegian pension fund, which is obviously one of the largest, I think it's probably the second or third largest in the world, in terms of the decision that they have taken to move away some of their assets over a period of time from oil and gas companies. Not extensively, but they have taken that step. And obviously they're an oil-based economy. Norway is where they have had it. So this is a really interesting signal, again, to some of the other discussions that we've been having about the low-carbon transition and the pace of change in terms of where that energy transition is happening and how different investors are responding to it. I think if you look from the Norway example, obviously they feel that they're heavily exposed to oil in many aspects of their economy, and how can they diversify away from that? And so these are important trends that we are constantly following and constantly trying to be alert to the best way for us to recommend that we respond. Did I answer the main points there?
Thank you. Thanks, Harry.
Joy?
Thank you. And Betty, I really appreciated your comments because I think when I first saw this, I had it's a similar reaction that in the absence of more work on defining how we would implement this, and more I think more consideration that Kirsty, you and the team would give. What I don't think would be appropriate to happen is for in that third column for the board and our board meetings to sort of serve as a forum for anyone who has an issue or a concern to bring it here, and that would automatically mean that it would go through some kind of a process. I do still think that there is, more refinement that we need to do if we move in this direction, to just think about how we would validate, or how we would confirm that it is something that would, weaken the trust of system members, or, something maybe that is brought to us from our members, but that also has the kind of economic risk to the fund or financial impact that warrants us taking a look at it as fiduciaries. And also making sure that we've done the sort of due diligence and the kind of analysis, again, along the lines that I think the staff did, looking at the private prison issue. So I also have some discomfort, I'm not sure if that's the right word, but just some nervousness about, thinking about how we build this out. Because I think there's sort of more definition and more guardrails that I'd want to make sure that we see here. But I also do think that we're looking for some resolution about how we do address the issues that our members and the stakeholders bring to us, because I think every one of us up here has a reaction and a personal position in terms of some of the issues that come to us that may be different from how we feel that we vote on an issue or take action on an issue as a fiduciary of the system. So I think this needs further, I would say that I think this needs further work, but I think I'm open to that.
Thanks, Joy. Thank you. Seeing no one else in the queue, a couple of thoughts. I would echo the comments of Betty and Joy relative to the third bucket there. Clearly, we need to refine that. Yep. On its surface, I really think if we could identify the appropriate forum for some of these issues that come before us would be, I think, helpful, whether it's inside CalSTRS or not. I'm not exactly sure, but from my perspective, I think there are a lot of issues that come before us that I care very, very deeply about and are supportive of. But in this role and in this capacity, it's not the right place from my perspective. I also have a slightly nuanced view on those issues. And I'll give one example, is the position we took on guns, and why we, as the largest teachers' pension fund, took the position that we did when guns were being used in the manner that they have been in America's public schools. For me, there was a clear line. These are our members. These aren't a secondary stakeholder group. So for me, it's a little bit more nuanced when there are members of the system. I think we have to take that into consideration versus stakeholder groups. And as I've thought about this issue, I'm not sure if it's accurate. What's come to my mind a lot is it's a more pure alignment of interest, is the sustainability and viability of this pension fund for the members of this system versus members who are not of the system. There's a pure alignment for me. So I think we do need to refine this and figure out what the right forum is, because I think all of us agree some of these issues, this is not the right forum for these issues to be addressed. Secondly, and I think with your enthusiasm, and clearly you're a great team that's in place already, and your strong communication skills, that we have the ability to improve our storytelling. And in doing that, that may actually help others to see what we're doing on a material level on issues that are important to a lot of people and important to the performance of this fund. And then thirdly, around the decision by Norway and others, when you think about what's going on in Saudi Arabia and their decision to not link their future to what comes out of the ground. That's a pretty leading indicator, right? At what's at risk in that part of the world and for their own people. I think that issue, should we address the issue of make the transition to a low-carbon economy a focus for the committee? We have to make that decision in the next couple of months. That might be a place where we can actually study something like that in depth and really understand it, along with other larger issues. So those are my 3 points. I support the notion of an appropriate forum. I would differentiate stakeholders who are members of the system from other stakeholders. Do a better job of communicating the great work that we are doing. And then thirdly, the optimism I have around making the transition to a low carbon economy and what that potentially could do for just the education of us as a body in a substantive way. Those are my points.
Harry, can I add
Yes, sure.
one last thing? Because I think this kind of ties into all the comments. And I think what we could do a better job in terms of everything that we are doing is partly with our engagement plan. Because I think that's the forum where, what you were talking about, Betty, what's the right forum? What's our role as shareholders? Where can we provide influence? What we've tried to do in that engagement plan is these topics where we have a specific role or we're able to influence companies and work with other investors, we want to showcase that, not just to the board, but I think we could do a better job of showing what our priorities are and where we can really affect change. And you're right, we don't even want to get to this point. We want to be able to use the engagement aspect as a way to help add value and mitigate risk to the system. And I think we could do a better job of showcasing all those activities.
And we will. Very good. And it was mentioned, the private prisons report, that was Philip LaRue who did that work. The dissertation on that, so. Okay.
Shout out.
Anyone else? I do. Betty, back to you.
Thanks, Harry. I wanted to just shift, if I could, to the proxy voting. Yeah, knowing that executive comp continues to be a pretty hot topic. Any thoughts about kind of a more aggressive strategy this time around, or kind of how you're approaching it this year differently, if any?
You know, we haven't changed any of our fundamental principles about how we look at compensation. We still look at, are there structures that make it a sound plan? Things like ensuring there's appropriate clawbacks, that they're using the correct metrics, that they have a long-term focus. None of that has changed, but there is starting to be a focus around quantum and sort of how these valuations are set for comp. And I think that's where we have to be careful, because we've seen it rack up every single year. And so how do we tackle that? Because we still want an alignment of pay for performance, and we still want to ensure that companies are using the appropriate metrics and the appropriate form of equity. Mm-hmm. So I don't know that we're necessarily changing it. We're always refining our process, and exec comp isn't like a lot of the other issues where it's sort of you have majority vote for directors or you don't. Exec comp, it's an art again and not a science. Right. And
all I'd add to that is just understanding the sophistication of, I think, coming into CalSTRS, the guidelines that we have in place to help guide a case-by-case analysis. Companies, I think, is incredibly important, not just picking a box on compensation, that this is based on either team members going through a very detailed understanding of what that particular company is and what's appropriate for that particular company. And those are where we do the deepest dives. And then everything else is the compensation is supported by a very strong compensation set of guidelines that we have to help guide our votes on individual companies. So I think that's incredibly important as well, that I still believe that, governance has to be and voting can be pragmatically applied on a case-by-case situation to each company rather than across the board. And that's a really important tenet that I think Aisha and the team have set up for us.
Yeah, okay. And then certainly reading a lot about the emergent IPOs, but any thoughts about how we're addressing the dual-class share structures through the proxy season?
So the dual class issue is one that I think we have to tackle it from all sides. So not only do we have to go company by company and make sure that we're expressing our views on this, but we've also sent letters to the exchanges in terms of how they manage this. Unfortunately, the SEC tried to tackle this issue many years ago, and because of a lawsuit, they're no longer allowed to address this issue. But we keep going at it, and we're trying to do it on all forms in terms of the policymakers, the exchanges, and company by company. And we're using the power of our voice with a variety of coalitions. We have the Council of Institutional Investors that have been very outspoken about this. We have the Investor Stewardship Group, where we have a direct principle about one share, one vote. And so I think the power that it's not just CalSTRS that has this view, it's the broader marketplace.
Right.
Yeah, and Betty, I just wanted to make one further comment for you that because we're such a large investor, you know that we have both active and passive investments. And when we own the passive investments, we end up owning some of the companies with the dual class structures. And so the work that Aisha and Kirsty and the team are doing is very important to help us manage and mitigate that risk over the long term.
Right, right. I appreciate that. Thank you. Thanks, Harry.
Thank you. Thanks, everybody. Thank you.
Thank you so much.
I just saw the Wells Fargo CEO just step down.
Nice job.
Overdue.
Yeah, exactly.
You're talking about Wells Fargo?
The CEO of Wells Fargo just stepped down. Yeah, yeah.
How long did that take?
Open session items 9A, B, and C. For the members of the committee that haven't been part of these before, twice a year we receive semi-annual reports from our consultants. This is part of our oversight responsibilities to monitor the portfolio on a semi-annual basis and relative to benchmarks and its performance. And we start with Alan Empkin. Alan, 9A is you. And I've asked each consultant to give us 3 highlights for open session, and then we're also in closed session when we can get into more finer detail. Alan?
Alan Empkin, Makita Group. Okay.
I forgot. I told Alan I did want to say something. Still focused on that. So, pardon me, Harry, for jumping in, but I just want to plant a flag because this is actually pretty momentous. For 32 years, Pension Consulting Alliance, PCA, has presented your semi-annual performance. And I'm not going to tear up, but I'm actually a little sad. I've worked with them actually longer than that, but this is the first time we get the chance to have Alan Empkin present as Pension Consulting Alliance. I know the merger went through, but still, the agenda was printed, it was PCA. So just a momentous chapter. And credit to Alan and his team, and it's been a great firm, and I think we've been their #1 client in their mind.
In our mind? In our mind. In our mind, too.
In our mind, too. So with that, I am pleased to turn it over to Mr. Alan Empkin.
Alan? Alan?
Yes, I'm somewhat in shock.
That's okay. But, no, all seriousness, in the 10 years that I've been on the board, you've helped me understand some issues better than I would have had you not been so accessible to me, often offline, in conversations in Santa Monica. And you've helped me understand my role, my responsibilities. You've added to my insight, you've made me, I believe, a better member of this committee. And you couldn't have been more accessible to answer questions and give me guidance. So from the bottom of my heart, thank you for what you've contributed to me in your role at PCA.
And you're not retiring, so.
No,
let's just
I was
address
just,
that.
thank you, Mr. Chairman, and thank you, Chris, but I'm coming to these meetings as long as you'll allow me to, so. It's important to keep in mind that your staff gives you regular performance reports. And those are much more insightful and give you better detail and provide a better venue, an opportunity to address your issues. This is a role for the independent third-party consultant to you as a board in the public session to address the big picture issues. There are a lot of small issues, not macro issues, but micro issues that we addressed in closed session. And it's just, for those of you who are new to the board, if you have questions about, call it detail, we'll deal with that in closed session. If it's macro, bigger issues, we'll deal with it in public session. And I, along with the other consultants, won't hesitate to let you know that's better dealt in closed session, or it has to be dealt in open session, as the case might be. That being the case, today's performance report is really, the timing is perfect because you really kicked off in real time the asset liability study, which will take place for the next 10 months. Performance is driven by that decision. 93 to 95% of the performance of the investment portfolio, both the risk and the return, will be driven by that asset allocation decision. The other 5 to 7%, in fact, if you go along with the discussion earlier today, you'll be dealing with that with your new risk process. It's very important to see what's really, really important in the big picture. And as trustees, it's asset allocation. So what happened last year? What happened last year was the global equity markets had negative rates of return. The US did much better than the foreign markets, but the reality is your portfolio is dominated by equity risk. It's public equities are the largest single component of the portfolio. When they go south, there's nothing you can do about it. You have to accept that as a cost of doing business. And I like to use homilies. There's no love without heartache. And the love is higher rates of return, the heartache is volatility. You cannot have one without the other. The question is how to manage that. And that is what the strategic asset allocation is all about. And it's why it's so important that you be integrally involved in that. What's fascinating is other risk assets in your portfolio did extraordinarily well in 2018. Your private markets, both real estate, infrastructure, and private equity had extraordinarily good rates of return with very low volatility. You might say, well, heck, why don't we put all of our money there? It's not volatile and had great rate of return. Well, the reality is because they're not publicly priced, you don't see the volatility. You didn't sell the whole private equity portfolio. You couldn't have sold it if you wanted it to. So the pricing mechanism, in fact, smooths that rate of return and is a lagging indicator, not a leading indicator. By the time we get to the end of the first quarter, the public markets have recovered from the losses in the fourth quarter of last year. And the people who are doing the valuations of the private markets won't look back and say, gosh, January was terrible. To a certain extent, they'll be influenced by what's happening now. And what that will mean will be less volatility. So do you have less volatility in those markets? From a perception, the answer is yes. But if you really tried to sell the underlying portfolios, the underlying real estate, the underlying ports, they would have been more volatile. But from a return and risk perspective, I'm really, really happy you had significant allocations to private markets because in fact it did enhance returns and it did smooth risk. For the year, the portfolio was down 3.2%. When you consider how much equities domestically and abroad were down, that's a great result. Why was that? It's because private markets and fixed income did their role in the portfolio. Over 5 years, your return was 6%. Over 10 years, 8.4%. That's beginning to reflect that the global financial crisis is a little over 10 years old. And so it's rolling off. And in fact, in the next few quarters, it will be not part of your 10-year numbers. And you're going to see a bump in rate of return for your real estate portfolio, because the reason why for 10 years you trail your benchmark by a little is because the real estate portfolio really did very poorly in the global financial crisis, totally restructured since then. But when that's out of the 10-year number, you'll get a real pop in performance. The good news is for 10 years at 8.4%, you significantly exceeded the expected rate of return on the portfolio, which means you added to the financial health of the system. But never forget that you have negative cash flow, and that's always a concern. And that is contributions are not as large as benefit payments. And so the staff always has to think, do we have enough liquidity in the portfolio to meet our obligations? On a relative basis, over all long periods and most recent periods, the portfolio did better than their peer, that's large public pension plans, and better than its benchmark. In close, we'll get into some detail. The only real disappointment, and it was a disappointment, was the risk mitigation strategies did not meet expectations. The reasons why we'll get into in closed session. But in the fourth quarter of last year, and particularly for the newer members, the risk mitigation was literally designed to deal with what happens when you have a prolonged bear market in growth assets, basically stocks. The fixed income component of the RMS did exactly what we wanted it to. And in fact, the best performing asset class in the fourth quarter was long treasury bonds. And in fact, if you've been noticing the market in the last few days, there's been a rally in long treasuries. It's unbelievable. The long treasuries down around 2.8, I think, which is really quite phenomenal, which ties right into the discussion earlier about the flattening or the flat yield curve. The investment portfolio has exceeded what one would have hoped. It's been done at a very, very competitive cost. And for the new members, there's a very detailed cost report, which you get once a year, which is second to none. And when you look at that and you realize the implementation and the modifications that have been made to the portfolio to create more of a collaborative model, all of that is working. There might be some little fixes at the margins, but the direction is the right direction. And as your consultant, there's nothing to bring to your attention that demands immediate attention.
Need to. Our next consultant report is from RC Elko, Ben Maslin, and Gady Kaufman. Welcome, Ben. Welcome, Gady. Good to see you. Gady and I run into each other in the same market in Brentwood.
Right.
Too much information. Go ahead, guys.
Hi, everyone. So I'm Ben Maslin with RC Elko with me is Gady Kaufman. Alan, I thought, said it well, that we are the real estate consultants. Will be providing an independent review of how the real estate portfolio did as of September 2018, so as of last year. So Harry asked us to highlight 3 items, and the first item I'd like to highlight is the allocation to the portfolio. And as of September, the allocation to the real estate portfolio, real estate comprised 14.2% of the total fund. And this was up from 12.7% in March of last year. So over a 6-month period, it went up by 150 basis points. And there's really, this is above the short-term target and the long-term target of the fund of 12% and 13%. And there's really 2 reasons as to why this occurred. The first was touched on by both Chris and Alan, in that the equities markets, public equity markets, underperformed last year and actually achieved a net negative return. And in turn, the overall fund declined as well by about $10 billion between March and September. And so what you end up happening is what's called the denominator effect, which is that the denominator in that formula has declined. In the meantime, at the same time, real estate actually performed quite well last year. And so what you had was an appreciation of the portfolio, and then also continued investment into the real estate portfolio. And so as a result, the numerator increased while the denominator declined. And so as a result, you have a larger allocation to real estate. That's since corrected somewhat to about 13.8% today. And that's because of the rebound in the public equity markets since last September. This is still in compliance, over target, but it's in compliance. There's an allowable 3% range above the target. So the maximum range is 15%. So an allocation of 14% or 13% today, 13.8% today is within the allowable range. Looking at the allocation across real estate strategies, and just to briefly define these, core assets are really less risky, stabilized assets, already constructed and occupied. Value add have some sort of risk component in them, where they're either being repositioned or have substantial vacancy in the asset. And then opportunistic is more speculative investment and can include development projects or heavy repositioning or vacant buildings. So today, as of September, the portfolio was almost 70% allocated to the core bucket. And this is consistent with past quarters. The loan-to-value ratio, that is the amount of leverage in the portfolio, was blended overall at about 34%. So in total, the portfolio is in a healthy defensive position, which is well within the compliance of the policies. So, thank you. Second item I'd like to cover is the performance of the portfolio. And the real estate portfolio outperformed its benchmark, which is the NCREIF Odyssey Index. It stands for Open-End Diversified Core Equity Funds. These are open-end funds. It outperformed the index over the past year, 3 years, and 5 years. Lagged the index over the last 10 years. And so I'll break those down a little bit each. On the shorter term performance, so the 1, 3, and 5 year, the portfolio outperformed both when factoring in the legacy portfolio as well as excluding the legacy portfolio. And the legacy portfolio includes opportunistic, commingled, closed-end funds that were invested in prior to the recession. So that's effectively higher risk, less liquid funds that are currently burning off and have actually deteriorated performance over this economic cycle, so over the last 10 years. So looking at the 5 year, the portfolio outperformed by 50 basis points over the benchmark, and including legacy funds. When you exclude legacy funds, the portfolio's return increased by almost 200 basis points, or 2%, to a 12% annual return, and that's 2.3% higher than the benchmark. Looking at the 10-year return, including the legacy funds, the portfolio lagged the benchmark by 190 basis points, When you exclude legacy, the portfolio's return was almost at the benchmark return of 4.6%. This is the last year that, or the last report in which we'll present a 10-year return that incorporates 2008 returns. Yes. So what does that mean? As Alan mentioned a few minutes ago, 2008 was a bad performing year for real estate. And if you break down the vintages just within CalSTR's portfolio, prior to 2009, returns, since inception, returns for those vintages were about 5% in total. Post 2009, that's about 9.5%. So we should see a heavy increase in the 10-year return when we present in this fall. Yeah, of course.
I'd like to point out the white boxes on that chart. Those are the boxes that had underperformed. Those are the strategies that did not do as well. And they have been informing investment strategy over the last few years, increasingly so, encouraging the managers and of course the staff to focus on value add and on core investing and de-emphasizing and only strategically undertaking opportunistic investing, which is opportunistic is basically ground up development. So lessons are being learned and applied, and the portfolio overall in time will get healthier and healthier. And you can see that the opportunistic performance is low when you take the legacy portfolio into account. But when you look at the portfolio on the right side, excluding legacy, those opportunistic investments actually worked out quite well. But interestingly, the value add, which in theory would be a little lower risk, showed a little lower return. That isn't explained by total results. Actually, the total results of opportunistic investments are greater in nominal dollars, in total dollars. It's just that when you invest in opportunistic projects, the time lag between investment and results is a little longer, so the IRR is a bit lower. These are IRR numbers. So the long and short is that the investment program that is now taken into account lessons learned from legacy investment, favoring away from closed-end commingled funds, favoring away from opportunistic investing, and being more surgical about making higher risk and hopefully higher results opportunistic investing, as shown with a preponderance of green boxes as opposed to white boxes on the chart.
Thanks. So looking at what's been driving these returns, you can really try to break it down into where the fund has been investing. So by where, I mean what property types. And within real estate, there's 4 primary property types. There's apartments, industrial assets, office buildings, and then retail properties. And then what has been bought within those property types. And really what we've seen is that the allocation has been somewhat beneficial across the board, with the exception of the industrial assets, where the fund could allocate more to industrial assets, which have been the best performing property type within real estate. And of course, one reason why that's the case is that's where a lot of the e-commerce businesses related to e-commerce sit. When you break it down into what's actually being bought within these categories, you could see nearly across the board that the actual asset selection is superior to the index. And if we look at office as an example here, the CalSTR's office portfolio outperformed the benchmark office portfolio by about 3.4%, 340 basis points. Significant outperformance. Industrial lagged a bit, but overall, the selection of assets and increased returns by a total of 1.3%. And so the third highlighted item is the portfolio composition, and in particular, the continued shift over the last 10 years towards controlled ventures, controlled strategies. And by controlled, I mean collaborative ventures, so those would be separate accounts or joint ventures with real estate operating companies, and open-end fund positions where you have control in terms of the exit. They're more liquid. And so in today, or as of September, I should say, approximately 80% of the portfolio falls within the controlled category. If you look back 8 years to 2010, just 46% was controlled. So truly a shift towards that. And even 5 years ago in 2013, that was under 60%. The other thing to highlight here is the continued burn off of the legacy assets, where today they comprise just 5% of the portfolio. 2 years ago, that was 15%. 5 years ago, that was 35%. And so, as I mentioned earlier here, as those burn off, the returns will only increase, and so they will continue to diminish going forward, and which means returns will only increase going forward. Looking at where capital is going, it's also going towards controlled ventures. And so what's shown here is capital that's committed but not yet invested. And through September in 2018, 3/4 of the capital committed went to controlled ventures. 70% of the total capital committed but not yet invested is to controlled ventures. Similarly, there's been, as Gadi mentioned, there's been a lessons learned and somewhat of a retreat from the opportunistic sector. And so 86% of capital committed is to core and value add strategies, and about 3/4 of capital, in 2018, 75%, 86% was to core and value add strategies, and about 3/4 of capital committed but not yet invested is to core and value add strategies. Multi-apartments and office are the two largest largest product types within the portfolio, and they also represent the majority of where capital is committed today. 52% of committed but uninvested capital in total is going to apartments and office buildings. So a few notes on the market and the real estate market.
Oh, I'm sorry. My bad.
What's shown on the top here of this slide is the spread between market capitalization rates, or cap rates, and the 10-year Treasury yield. And the cap rate is effectively the yield that you earn on real estate property. And so what happened in 2018 for the first time in this economic cycle is that the spread declined below its historical average. Now, we heard earlier how the yield curve became inverted for the first time last month. This is effectively the equivalent of the yield curve becoming inverted for real estate. And while it's not a true predictor, it can go much further, and it can be below its historical average for quite a long time, as seen in the 90s. This is a kind of a shot across the bow to say that pricing is rich and yields are, the risk premium may have declined somewhat. Nevertheless, capital markets in real estate is quite strong. Transaction volumes are at peak levels and have been for the last 4 years. They remain robust. Capital raised for real estate investing is at record highs, and that comes from U.S. investors and offshore investors as well. So lastly, we continue to think we're in the late stages of the real estate economic cycle, but that the real estate market remains stable with no warnings of declines in demand, no reasons to think while demand will decline, and new supply of real estate moderating. Where returns are going, this is what's shown here is the Pension Real Estate Association prediction of future returns. Participants believe that income returns will remain stagnant or decline modestly over the next 5 years, but remain quite stagnant, whereas value returns or appreciation returns will actually dip negative in 2020 and then be close to zero thereafter. Industrial is projected to be the strongest performing asset class. That's again due to e-commerce demand. The flip side of the e-commerce coin is that retail is projected to be the worst performing product type, with office and apartments in the middle there.
So the implication of that is that the focus for investors and for operators has to be on the operating fundamentals. If you focus on the chart on the bottom left corner of the page, it basically shows that appreciation returns are going to be minimal, maybe declining at least in 2020 by the prediction, and that all the growth in value will come from income increase. To increase income, You have to manage cost and you have to manage revenues. And that is where the excellence of the managers that are working for CalSTRS will come to play. We'll find out how good they really are. And if the staff needs to focus on one thing, and one thing only, well, they don't have to focus on one thing, but if they did, it would be making sure that operational efficiency and effectiveness is foremost in the minds of the partners. Watch the dollars, the pennies, and then the whole portfolio will take care of itself.
Thank you, Ben. Thank you, Gaddy. And maybe we'll get into more detail in closed session on some of your slides and some of your comments. I don't see anyone here, so thank you.
Thank you.
So John Haggerty and Steve Hart from Makita Private Equity. John, Steve.
Hello. So we thought we'd step back from the asset class just a little bit for the benefit of the newer investment committee members and dovetail some of our conversation with the earlier conversations about asset liability and the role of private equity. So this first slide revisits the reasons why you have a private equity program. And as Josh talked about earlier in the asset liability study, these are bucketed very closely to stocks, and appropriately so, because the underlying assets within both your stock portfolio and your private equity portfolio are operating companies. And the risks are, in many ways, the same. And also, this is a part of your portfolio which is designed for the very long term, has a very long-term duration. With asset liability or asset allocation modeling, the appeal of private equity is return. We are expecting a certain premium over stocks. So the private equity allocation in terms of its objective is often framed relative to what you get relative to stocks by making the investment in private equity for all of the various drawbacks that it has with respect to transparency, fees, and lack of control, et cetera. But we do feel that CalSTRS is in a unique position, like many very long-term plans, to capitalize on the long-term nature of your pool, your long-term objectives, and the long duration of these assets. So it's quite appropriate. The pricing today is quite high, and in addition to some of the drawbacks that are noted on this page, are ever more on our mind. But in spite of this, we note that we continue to see allocations from large pension funds like yourself go up or more or less stay the same. Recently, Bain & Company published their 2018 report on allocations globally, and it showed increases more or less across the board, with an occasional fund moving its allocations somewhat down. But the resounding opinion globally for private equity is that it's an asset class that institutions continue to have faith in. On the bottom of the page here, you see some unique opportunities that your private equity program can capitalize on. You have a large, sophisticated, and capable staff. This plays into the collaborative model, which we'll talk about a little bit later. You can invest at scale, which means that you can be a very strong and sophisticated counterparties to some interesting transactions that are noted at the bottom. Co-investments and secondary transactions, spin-outs, all the focus of the PE collaborative model require that on the other side of the transaction that the counterparty be large, liquid, sophisticated, and you have all those characteristics resident in this building.
So Steve Hart from Makita. So with that, we recognize there's also some challenges that exist at CalSTRS. So one of the issues with regards to investing with such a large program is just actually getting the capital out the door. Unlike public securities, where can more or less ring up a broker or an asset manager and deploy the assets relatively quickly, it is more of a challenge to actually, for the staff to, in fact, identify and negotiate agreements with a range of investment managers in private markets. They think that they can be top quartile, and that's as a goal for them to do that. And that they're just not as much necessary, being tied to the fundraising market as well, that sometimes there's a lot of those managers are out in the marketplace and sometimes there's less. So being able to consistently deploy the capital at scale is a challenge for CalSTRS. Next, talking about the construction tilted to buyouts, and what means there is that, again, investing at scale, trying to invest with managers that can take the capital at scale. So it means that some of the smaller managers or ones that are focused on maybe early stage venture capital, just the underlying companies don't need that much money, so it's harder for CalSTRS, given its needs and desires, to invest more capital at scale. It's just harder to get that exposure in the marketplace. In their portfolio. Next, about the complexity of the portfolio and execution risks, as there's additional ways of going about talking about the collaborative model, just adds additional complexity to the portfolio. And finally, benchmarking is challenging just generally in private equity, but also as we're talking about some of the newer strategies later on, that some of the initiatives that the staff is rightfully undertaking are not as well benchmarked, and so it just adds some complexity in that benchmark. So what it is that the staff is doing on that, so the collaborative model, as John was mentioning, primarily focused on co-investments at this stage. That helps address the scale issues, helps to address some of the control on the exposures, being able to pick the geographies and the industries, increases transparency and should be beneficial on the fees side. But it does add to some complexity and execution risk. The pacing plan, working with the staff to develop a long-term plan so that over a multi-year period that the plan will eventually reach the 13% target. Again, that's going to take a number of years of consistent deployment to reach that. We're spending a lot of time with the staff talking about the benchmark. And thinking about both the long-term and short-term benchmarks there and doing that review. And staff is working on exploring these newer strategies, longer dated and multi-strategy as two examples.
Structure of the portfolio will not change much from year to year or every 6 months. So these figures are more or less the same that you saw 6 months ago. Buyouts are roughly 70% of the portfolio. Also, the United States is around that percentage as well. We have noted many times that there was a large exposure to a certain set of vintage years, but we're happy to note that the uncalled commitments in these vintage years is very limited, and that means that that exposure as a percentage of your entire private equity program will continue to go down.
In terms of performance, the performance continues to remain quite strong. During the 6-month period between April and September, the total value of the program increased by over $1 billion. And that the performance compared to what it was when we reported back to you in the first quarter, that overall performance calling on a since inception basis is essentially unchanged. Looking at the variety of benchmarks that are used, number one, noting that again there was a change in the shorter term peer-based benchmarks that are driven by State Street private equity indices. That the CalSTRS portfolio is close to those figures. But remains somewhat below the custom PE index, which is the performance that is used to calculate the program's overall returns, and that's a benchmark that's changed some over time. It's primarily focused on the public markets plus a spread. We do note that in some discussion with the staff, thinking about making a change to the long-term benchmark that to reflect a broader world index, which is used in the global equities portfolio, which is the ACWI index, that the private equity performance at 10% over 10 years reflects very well against the ACWI index, which had an 8.5% 10-year return. In terms of activity, The private equity program continues to receive cash flows. It's as we had in our overall report, showing that that's more or less balanced out, noting that over the last 8 years, CalSTRS has received about $20 billion more in distributions than what it has contributed in over that time period. That flow has more or less balanced out as expected as the increased contribution and commitment pace that has taken place over the last several years is starting to draw additional capital. And as I mentioned there in that second bullet point, in the second half, staff committed about $4 billion in the second half of the year, and the total year was just about $7 billion.
Some of the aggregate figures for the private equity program. First, the total program assets. The NAV, or remaining value, plus the unfunded commitments gets you to a total exposure of $37.5 billion. I'll call your attention to the percent of remaining value column. There are two areas where you're somewhat different from your long-term target. That is, buyouts are 5 percentage points above, roughly, or 3 percentage points above the long-term target. Correspondingly, debt-related strategies are 5 percentage points below the long-term target. Neither is a cause for concern. Both are well within their target range, and there are reasons for those exposures to be different from the target.
As I mentioned a little bit before, this is a chart showing the contributions and distributions into the portfolio with the line showing the net number. So the blue lines going down showing making contributions into the portfolio, and the maroon lines on top showing the cash has been received back by CalSTRS over the years. So since 2010, 2011, there's been more cash received back than has been contributed in, and that's an aggregate of about $20 billion. But that trend has been slowly reversing and going back into a period where there's being more cash being contributed into the private equity program that's been returned back. That's makes sense in all the pacing plans. We account for that, and the staff accounts for that. As the staff continues to make commitments to the program in the $7 to $8 to $9 billion range, that the program will be a user of liquidity rather than historically been a provider of liquidity.
Here you see more detail on performance of the private equity program relative to a few benchmarks. The story, the headline is very much the same as prior reports, where the since inception figures remain positive relative to these benchmarks. In the shorter periods of time, there are deviations from that. The most notable are relative to a fairly difficult benchmark, which is the custom benchmark, comprised of a set of equity indices, stock indices, plus a premium. So if you were to take a look at the footnote for each of them, I think they're quite relevant as we consider benchmarks going forward. But historically, the figure for the custom benchmark was 500 basis points greater than the Russell 3000 index, which is a broad measure of U.S. stock market performance, and also plus 300 basis points. And as you'll see when you get into asset allocation work, that the actual difference that is forecast by us with respect to stocks versus private equity going forward is about 150 basis points. So that's something that we'll be looking at when we address benchmarks relative to stocks and the premium to be expected. The custom benchmark, of course, is the peer benchmark that we have tuned to be mirroring the exposures of the program with respect to vintage year and sub-strategy. This last slide really reiterates things that Steve had said earlier: a modest underperformance across most time periods for the peer benchmark and slight outperformance since inception. The stock market benchmark that we're focused on, which is MSCI ACWI, on a go-forward basis, which is a global benchmark, had performance of 8.5% over the last 10 years annualized, and your program had a 150 basis point premium return over that, which is commendable. So that concludes our semi-annual report.
Just, thanks. Last point there, that's net of fees?
Yes.
And the MSCI 10-year was 8.5,
Correct.
and arguably one of the strongest bull markets in history, right?
Yes.
Yeah. It's how powerful private equity, the role that private equity plays for the portfolio.
Indeed.
Yeah. Thank you very much.